Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us for another episode of the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have with me Seth Bradley. He is the host of the Passive Income Attorney podcast, which he's recently launched. And he's got a lot of stuff going on. So this guy is I'll call him probably not a serial entrepreneur. He's like whatever it's called. He's a parallel entrepreneur where he's got all sorts of things going on. But he's an attorney, obviously by trade. So he's a partner in the Law Capital Partners, and been in the real estate business for a long time as a broker, and so I think fundamentally he's a real estate guy. So we'll let him sort of introduce himself here in a minute. But I thank you for joining us today, Seth.
Yeah, appreciate you having me on today, Lance. It's kind of a hodgepodge, but it's all interrelated. I just like to say a real estate entrepreneur. You pretty much nailed it there. I'm a broker, investor, and real estate attorney.
Yeah, no, that's great. So why don't you kind of give us a little background into, how did you get into real estate? Obviously went to law school and those sorts of things, but what drew you in and what sort of brings that passion for you? What is it about real estate that you love?
Yeah, I mean, it's kind of tough to identify. I mean, I grew up in a small town in West Virginia. There was not a whole lot of entrepreneurship going on, let alone, owning commercial real estate or properties or anything like that. My dad's a coal miner. My mom is a teacher. I'm retired now, but, so it was just kind of like work hard, make good money, So growing up, it's just like, figure out what is the best job that you can get. So I ended up going to med school for a little bit, hated that. And then I ended up getting my MBA and going to law school. And during law school was when I started kind of really falling in love with real estate and real estate investing and all that kind of stuff. And, I got a really good job at a law school at a big law firm and kind of went down that traditional pathway of like, okay, now my goal is to make partner and just kind of move up that ladder. But as I was kind of making those steps, I just kind of got to see, these older partners that had quote unquote made it. And, they still weren't that happy. They're in the office just as long as I was, if not longer. And they've got administrative duties and educational duties and all this other stuff on top of all their billable hours. And, that's when I think I got to the breaking point where I said, I don't want to continue down this pathway because I can see exactly where it's going. I mean, look at these guys down the hall. I don't want that for my life. To me, there's just more to life, and that's to, have time, freedom to spend it where you want, with who you want, and doing something that you enjoy. And I've been drawn to real estate, and my law practice was focused on real estate. So I saw these guys, the principals on these large commercial deals, and, they're not Donald Trump. They're, regular guys like you and me doing these massive deals. And you're like, man, I know these deals in and out. I can do this too. So that was kind of my aha moment. And I started kind of working my way out of that. Started with family, flipping, rental, things like that, and worked my way up to the commercial stuff.
Yeah, very good. So for you then, are there particular property types or markets that, that you're actively looking at? Like what's your investment mandate? What's that sort of buy box or, the areas in particular that you're operating in?
Yeah. So, I mean, the commercial stuff, I've been in it for a couple of years now, and it's easy. And there's so many people in the multifamily space, right? Because I think it's very easy for people to do what I did, which was, start in single family or duplexes or quads. And then the next normal step would be to just kind of go to more units. Kind of keeps you in the multifamily space. Mm-hmm. So that's kind of where our focus is initially, just your typical value add BC types of properties. And that's kind of changing a little bit nowadays because of just the market and the way things are going. You're better off because the margins with the B and C properties are kind of thinning out a little bit. You're almost better off just going after the A if you can make it cash flow. But we're definitely looking at other types of assets like mobile home parks, self-storage. And, outside of that I kind of put those three things together. A lot of people for those three things in general, but then really with like assisted living and hospitality, I see some really big opportunities there. Assisted living, obviously, because, the great tsunami, so much of the population is getting older. And then hospitality, because it's struggled much recently, but I think there's an opportunity because that is absolutely going to come back once this kind of recent pandemic stuff passes.
Yeah, exactly. So, I mean, I think you live in California, right? You live in Southern California? No?
Yeah, San Diego.
You live in San Diego. So is that where you invest as well? Or are you actually looking in other markets? I mean,
no, I don't invest in Southern California very often. I broker deals here. It's tough to make anything work. I mean, a lot of times, you basically park foreign investor money here because they want to buy in Los Angeles or San Diego or Southern California because that's just kind of what they see and what they know. And then, if they can just park a large sum of money there, they'll do it. But for us that are kind of in the industry in the United States, I mean, you've got to go outside of the Southern California market to make deals work. So we're looking, in the Sun Belt. I mean, I love Texas. I love Arizona because of its proximity to California and also the Carolinas. And I've spent some time living in the Carolinas as well. So I know those markets pretty well. Got it.
So, your process then of, looking at opportunities, when you're kind of underwriting and, what's sort of that overarching, philosophy or the things that, I mean, I guess it may be more easily said as sort of like what DQs a deal. What's sort of for you, you're running through it and you're like, no, that don't work. What is this thing that sort of disqualifying or, kicking deals out when you guys are looking at stuff?
Yeah. I mean, a lot of it's just the risk reward, it's just the risk profile. I mean, if you're going to when I say value add, these usually aren't heavy value adds because that doesn't really match my risk profile. I don't want to take an apartment complex from 30% occupied to 90%. That obviously increases the risk. And, when you look at development deals, that's obviously increases the risk. So it really just depends on what we're looking for at the time, because a lot comes down to the investor appetite, right? I mean, investors sometimes want more risk because of the reward at the end of the day. So they're looking for those development deals. If I have some large investors that are looking for that sort of deal, I'll keep my eyes peeled on partners that are doing those types of deals that I can partner with and bring some capital and some know-how to the deal to make that thing work.
Yeah. Yeah. So do you see, I mean, it seems like there is a trend, and maybe it was always there and I just didn't, notice it but I mean, it seems like, I think what you're referring to is sort of a co-GP arrangement, right? Where someone scrapes and finds a deal and, guys like you're obviously, there's lots of, budding relationships and sort of networking and those sorts of things, but maybe give us some more insight into that. I mean, I know for, you being a real estate attorney and having that law background, but, what do these deals look like? And I'll preface it a little bit by saying, with my day job is sort of running Verivest, and we've recently launched sort of a sponsor directory, to try to create a single source where a bunch of, where once again, investors of all shapes and sizes kind of go and figure out who's transacting, where they're transacting, filter a directory, narrow it down. It's sort of the online version of, COVID's kind of forced us to have to do that. But it's interesting, because it seems like it's breaking it a bit, is that if you've got all of this sort of co-GP activity, what that would mean in my own language, right, is that a bunch of sponsors are sort of like coming together and doing deals, right? So it's not as clear cut as like, this particular sponsor's doing the deal. They might actually be, three different groups that are sort of making the deal happen. Like there's operator, there's someone who's going to do the, operating of the deal. Someone's going to help bring the capital, those sorts of things. So maybe give me some insight, as since I'm not a guy who's kind of in that seat, trying to be part of that. But have you seen that as like, is it a trend that's happening? And, and how do those sort of co-GP things, how do they go down? Like, how does the transaction, how do people sort of solidify those sorts of partnerships and the roles and responsibilities and things like that?
Yeah. And I agree with you here in that I think it is a trend. I think more recently, you've just seen people partnering with people on a whim. I mean, it's just kind of like, hey, I want to get started. This guy's going to let me in the deal, so I'm going to jump in that deal with him. From my perspective, I'm typically a capital raiser, and then I provide some legal services and due diligence services as well, and things like that. But before all that goes down, the most important part for me is to establish that relationship with the direct sponsors. So the guys that are actually acquiring the deal and are going to run the thing and execute the business plan on the back end. I have to get to know them and trust their process and see that they have a track record before I'm going to take my investors and allow them to place their money with, this deal. And I think that's really important for, passive investors to look at, because, a lot of times it is a capital raiser, someone that's not actually going to be doing, the asset management on the back end after a close, something like that. And if that's the case, that's fine, but you need to make sure that you trust that person enough that they've done their due diligence on direct sponsors, or you do your own due diligence on those direct sponsors.
Yeah, no, that makes sense. And that's sort of what, and that's, that was the thing. I call it shortcutting the time to trust, right? So for me, especially now that, between the Jobs Act that passed, we're now 7 years in on that, publicly advertising, soliciting, and just the fact that, people do, like, that's just it. Like, it used to be that, you play golf, you're a member of a country club, and you were a doctor, and then you ran into a real estate guy who bought that, 80 unit apartment building that you drive by every day. And now you're a partner in that deal, right? Like, right. So it was very, very, geographically, narrow as to how it got done. Jobs Act clearly opened that up, and we've been seeing that. And so I view it like, version 1.0 was sort of the whole, real estate crowdfunding sites like Realty Shares and Realty Mogul and Real Crowd and CrowdStreet, and it's fine. It's great. Obviously, it creates some access. But what we've seen on that is that now most of those sites are, predominantly listing what I would call, much more tenured sponsors, who've, transacted for years and decades and multiple cycles, which is great for the investors, but it's become an alternative for the guys who predominantly raise capital from, institutional investors at terms that, the sponsors in the real estate investment didn't love, and now they're able to sort of get a more squeeze, because there's a lot more investors in a deal, and someone's kind of handling the pain that comes along with that. Right. So great. It's good for 1% or less than 1% of sort of the people that are transacting, but it's not great from the passive investor standpoint. There's not much product on the shelf. Right. There's not many opportunities. And then clearly you've got, markets where everyone's moving out of and markets moving into. Right. So people, they want to invest in, in different areas. That makes sense, but there's not options and those things available. So, my thinking was, what I always heard from investors was, man, I'm only investing 50 grand or 100 grand. I'm not really in a position of strength here to to get what I want, but I will, if I'm being honest. I'm nervous, and I don't know if these guys are good guys. They look like they're good, and they're really slick, and they're great marketers, and yada, yada, yada. But I'd really love to run a background check on these guys to make sure that, because there's not much regulation in, the smaller firms, obviously by design. And then on the flip side, the whole thing is like, dude, I have no idea if their track record's legit or not. They could just made that crap up, and I have really no way to know. And everyone talks about the track record. It's all about the track record, right? But it's basically like you just plug crap into a spreadsheet and you can just pass it off as though, you've done all this stuff. And for most people, they're none the wiser. So for me, as the entrepreneur, much like yourself, I'm like, ooh, there's an opportunity there. What if us, as the Switzerland, as the I don't got a dog in the fight, people, what if we just ran background checks on sponsors? Right. Exactly. We run background checks. We figure out what it is. These guys are willing to sort of put it out there. If they're bad dudes, they don't cut the mustard and they don't get to be part of the program. And if they are, they're fine. And if they got a track record, we can verify it once and an ongoing basis so that everyone knows enough of this fluffing up. Like, you've only really bought $100 million worth of property, but you keep telling everyone you've done 200 million. And so that's the thing, right? But the hitch in the giddy up, right, is the fact that, it's good, I think, even for like what you're saying, is that you've built an audience, you've got people who know, like, and trust you, which is what I think I want to promote more of. Like, I feel like this is the answer in here, is that they get to know you. And once again, the amount of effort, not just what we do, because like for us, it's not the full due diligence, right? It's just a part of it. But if we can make it easier for guys like you to go like, hey, these guys are clean, got good background, like they got clean backgrounds and their track record's legit, and I kind of know what they're doing, then it's that next phase. And maybe you can give us some color into what you do, but it's like, now you really got to dig in to get to know these guys. Are they really good? Because it's all about execution, right? And maybe you can kind of speak to that. Like, what are the things that you do to sort of ascertain that? Like, how do you figure out if, like, is it because you like look at their pro formas and you're able to sort of pick holes in it? Or is it like, there's like this philosophy or things that they say that sort of point to like, these guys know what they're doing? Like, maybe give us some insight into the things that you're looking for when you're having those conversations.
Yeah, for sure. And I mean, I think you nailed it there. I mean, the value that we provide is to vet these people, vet the sponsors, vet the market, vet the deal, so that the passive investors don't necessarily have to go into that much detail, and they may not even be able to do it. And as to answer your question directly, yeah, I mean, passive investors, they may be very educated. They might be doctors, lawyers, dentists, whatever it might be, but this is probably not their forte. They don't know to look at a pro forma and see where the holes are. They can't look at a pro forma and say, oh, well, this doesn't make sense. Or they might not be able to see that, the sponsor built in a 5% organic rent increase in that, which is not what they should be doing. Just little things like that you can poke holes in a pro forma, and you can vet that for them. If they know, like, and trust you, then they know that you've done that and you've conveyed that message to them. As far as vetting the sponsors, I mean, it's more of getting to know them. I mean, you've got to have those conversations. I mean, it starts with a phone call, then it goes to, you go meet them in person, you go view a property with them, you see their process, you meet their team, and you can just kind of get that gut check. It's just like when you meet somebody the first time, they might be able to put up a facade, but after that, after you get to know them a little bit and you see them 2 or 3 times, you can kind of tell who they are. You get to know them over time, and it just takes a little bit of repetition, a little bit more time that you spend with them, a little bit of asking other people in the industry about them. Is the track record real? How have these deals turned out? A lot of times they're honest about their track record, and they say, look, this one deal that we did, it's a break even. It's not even doing that great. We had to hold back distributions for a couple of quarters before we could distribute again. That's a really good sign, because they're at least honest and upfront. Things don't always go right. So you just got to really have those difficult conversations, kind of just have that gut check. Is this person telling the truth? Are they truthful? Are they honest? And you can kind of get that feeling pretty quickly.
Yeah, no, it makes sense. And I think that is, and I'll tell you what, I mean, like, obviously for me, and I want to see this part of it more formalized. So when I look at sort of an adjacent sector, which I would call like venture, right? So like in venture capital, you've got down on Sand Hill Road or whatever. I mean, these giant venture capital firms, right? I mean, the reality is that real estate has the equivalent. They're private equity real estate firms that are gigantic, right? And they raise money from pension funds and endowments, and and they put money out, and like, it's so a lot of the things are the same. And I think that the part, much like what venture ended up doing, was the whole angel investing movement, right? Where you did have these people who were obviously interested in getting some exposure to venture, but once again, they didn't have the kind of bandwidth to develop the relationships with startup founders. It's a whole thing, right? And so, but they want to be involved, but they don't have that time to take that. And so I think what you saw, we kind of look at ourselves at Verivest as sort of trying to become the angel list of real estate, at least the middle market real estate. In that, I think it should function much the same, right? Is that I mean, if you're an operator, direct operator who's trying to find deals and underwriting deals and take them down, and then obviously execute the business plan, it's a lot of work. Like, it's really hard. And in managing and maintaining and developing new relationships, no matter what, is hard, right? And you can't maintain 300, 400, 500, 600 relationships. Right? Like, it's overwhelming. It's too much. And it's just like the startup founders. I mean, they don't have time. They need to go and they need to be able to get introductions to people, develop relationships, guys that know what they're talking about, whether or not that, passes a sniff test or not. And, and they can do that. But what makes sense, and like what AngelList has, like the syndicate program, like you can go, if you know what you're doing, you can form a syndicate. right? And just press a button and you basically tilt up an entity and a bunch of, other people can put money in. And then that goes in as one line item on the cap table into that startup, and, away they go. But I guess my point is like this whole rising up of sort of this new kind of micro private equity real estate where there's guys like you, who can do that, because it is a valuable service of what we're talking about. The ability to sort of keep them honest, make sure that, that those projections are having another set of eyes that are looking at them, and just sort of that bullshit meter to make sure that like, hey, you got to win us over. We're not just dumb money. Right. And if you've got, now you can have fewer number of relationships. And then the benefit too is that for the passive investor, the ability to create diversification, especially if a guy like you creates like a fund, it's much the same, a small fund, you're basically allocating to 10 deals a year or something, and someone could put 50 grand or 100 grand in, they get exposure to 10 deals instead of putting the same 50 or 100 grand into a deal that might go sideways, right? Where they're just a small fish and someone's not, so for me, that's the whole thing, that we need to see more of that. And I guess the way I look at it, and you as an attorney, maybe you can speak to this, but to me, the whole co-GP thing, although it works, it's not ideal. Like, I don't feel like that's the long-term answer, right? Because then that just seems like partnerships are hard. Now that's a whole nother net new partnership that's going to break down eventually. I think that what makes more sense is we need to solve the problem of make it easy for a guy like you to go, love this deal, press a button, tilt up an entity, you negotiate enhanced economics, so they're already open up. The minimums go up at the deal level, right? And now all of a sudden, there's enough room left in there for you to earn your fee, some kind of management fee and some kind of promote off of those investors, right? And obviously you've got some other securities laws and things, but the point is, I just think it's a more efficient sort of distribution in a way that I think that's where it's going. And I think that works better for everybody. What do you think?
Yeah, I actually agree with that 100%. I mean, if you break it down, the deal into its most simple terms, you've got the money and you've got the deal, right? I mean, you can break the deal out down into the acquisition, the financing, closing, asset management, all that kind of stuff. But really, you've got the deal and you've got the money. If you can allocate those two things in a streamlined manner and in a legal way, I think it would make the process just a lot easier, instead of what you're alluding to with the co-GP is like, this guy does a little bit of this and a little bit of this and a little bit of this, and the other guy does all those things as well, instead of just having one guy does this, one guy does what they're good at, and let's make the deal work. Yeah.
And it's not to say like I'm anti co-GP. I think that it makes sense, it makes sense in certain situations. It's just that it's, right. Like, I think if everyone sort of come in alignment, we could just make it run more efficiently. And I just think, to me, a lot of it just starts at just getting those formation costs down. Obviously for us, we've been sort of at this now for, 7 years, sort of building this. And so, because we came at it from an accounting perspective. So to me, I just felt like the gating factor was the quality of reporting, and it went down to the financial level. So until that improved, everything I just said could never happen, because it's too complicated. And then that's what creates bloat in the costs, right? And if you start to get more standardized sort of structure of how deals are structured, right? And then you've got more consistent reporting, so that because all these are partnerships, unlike startups, which are usually, C corps, right? And then basically you put money in and there's an 80 or 90% chance that it goes to zero, right? So there's no income until the end. I mean, there's a lot fewer moving parts. But in a thing like this, I mean, if we can keep those costs down, the administration costs, I feel like there's a problem we've solved. It's a solved problem now. The ability to subscribe investors efficiently, the ability to administer those, to prepare the financials at the SPV level, all that stuff, do the tax return, all that stuff are sort of solved problems. The last one is sort of the legal piece, right? And it's that notion of, at the end of the day, you're selling securities. You got to make sure. And of course, right now, many of the syndication attorneys or whatever that are out there, I mean, they've built their whole businesses on, charging people 15, 20, 25, 30 grand per crack. They're not like super thrilled to suddenly have their whole businesses commoditized. And, most of them they'll unconnect from me on LinkedIn after they hear this podcast. But I'm just saying, like, I think that's where we're headed. And that's why I love I love having guys like you on. I see it happening, and I think it makes sense. And I think some of it too, I've seen that in not necessarily, you in the case, but I see some guys, it's like they almost feel like they have to apologize for themselves, right? Like they're apologizing that they're playing that, or that they may play that role. And I'm like, what are you apologizing for? Like, you're creating value, right? Your ability to figure out who's doing good deals and who's not, and keeping them in check, and doing the deep levels of due diligence, and visiting the properties, and, maintaining the relationship, and translating, and, all that stuff. Like, there's a lot of value created there. There's nothing to apologize for. Right. Because you see some people are trying to make it sound like, well, I'm the operator or whatever. And they're trying to make it like, okay, well, maybe kind of, but not really. Like, could you force the sale of the property right now? No.
Yeah.
Could you? Well, okay, then you're not, it's okay. Like, you don't control the deal, and that's all right.
I mean, there's certainly value there. And especially with the passive investors, I mean, the whole point of them being passive is so that they can do as little as possible, right? I mean, they have day job doctors, they're lawyers, they're high income professionals that have expendable income that they want to diversify into, commercial real estate outside of stocks and bonds and things like that. And in order to do that and still be successful in their career, they've got to be able to rely on experts to do these sorts of things.
Yeah, definitely. So for you, like when what do you see sort of when you're looking at deals, the thing that, what kind of stuff do you see, like deals that are getting done that just like terrify you, or like the thing that a lot of people are doing that you're just like, my God, like it's just scary stuff. Like, and like mainly around like how they're underwriting deals. Because it sounds like whenever I talk to guys like real estate analysts, that just seems like that's where they go. They're like, oh, that's a crap deal, and whatever. And I'm just like, what's your basis? And often they can't kind of describe it. But for you, as you're kind of always looking at deals like that, what is the thing that you see going on where you're just like, oh my God, these guys are just out to watch?
Yeah, I mean, you can spot some pretty quick red flags in the underwriting. I mean, I mentioned, but like the organic rent growth, I mean, especially with all the uncertainty going on right now, you've got to underwrite 0 for the first lease, and probably a lower than expected going forward. And you, the pro forma, sometimes you can't even see that. You need to ask them about it and have them show you kind of their back office underwriting to be able to identify that. And passive investors wouldn't know to ask, be able to identify that anyway. So that's just one thing, having adequate reserves, whether they place those reserves above or below the line, things like that. I mean, on top of that, I mean, things that I'm seeing that I don't like is, these same deals that I saw, that are called value add deals are coming through the pipeline for the second time or the third time, and they're still being called bad deals, and they've cycled through and sold, 3 times in 5 years. I mean, how much value add is still there? There's not a lot. I mean, there's really not. And there's just so many people, especially family space right now, that are just taking anything. And, you can manipulate that underwriting to make those numbers work, but those deals aren't there. They're not that easy to find. So when you see the second or third turn on that same property, you need to put your antennas up and really look at that again and say, is there really value to be created here or not?
Yeah, no, that's a great point. Yeah. And I was talking to someone the other day, it's like, certain markets, they just transact a lot more frequently, right? Like you said, Texas is an example, and I think you're right. Like it's the whole, how much meat on the bone can there be after 3, how much more value add? Like, it seems like you're adding new levels and layers of risk that, like, I get it. We added Core Plus. I mean, okay, I can get behind that, right? But like you go value add to value, deep to light to medium to, Core Plus to whatever. Like it just doesn't. And I guess I can see how we got there, right? I mean, it was like that last recession, it was just such a deep freeze that then led to this just like historic bull run that I suppose for many guys who kind of got in at that time, like they don't know any different. They literally think it keeps going up and to the right forever and ever and ever and ever. Yeah. And, it's like, no, I think that we're at the top. It's like that roller coaster. Like, I think we finally got to that top. I mean, and hopefully it doesn't like drop off, and I don't think it will, but I mean, it can't go up forever. And I think that, right. That's where, and that is for me too, is kind of the thing that would it scares me. It's just that mentality that's usually how we all, people start losing, is when you kind of think of things like that. So.
Yeah. I mean, yeah. And when you're seeing these, these deals come through, and you're looking at the OM, and you're looking at values of like, 3x multiple, or, 25% IRR in your typical 5-year value family property in downtown Dallas or something. I see this and I'm like, in the world, I can't even bother looking at the under. I obviously know that is not feasible, but like, to somebody looking from the outside in as an investor, where they might look at that and just compare, that to lower returns on another deal, and just go with that deal because the high returns, because they just assume these guys know what they're doing and what they're talking about. And in reality, if you see a deal downtown Dallas, or downtown Charlotte, North Carolina, or something like that, they don't exist. Like, that is a fatal flaw. I mean, that deal's not even worth your eyes to look at the underwriting, because it just doesn't exist. If you want to see the returns that you were seeing 5 years ago, you've got to go out to the submarkets of these places, these same cities, the submarkets, or go into the secondary, tertiary markets. Yeah. I mean, those returns just aren't there in those primary markets.
That's a good point. Yeah, and I think that's a great point, right? Like, it's like, okay, if your return requirement, if that's what your return requirement is, you need to realize that downtown Dallas, downtown Denver, downtown Charlotte, no, it's not going to happen. But if that's what you think you need, then you're going to have to move a lot further out. But once again, even then, more than likely, the risk adjusted return you're generating, so you still won't be compensated enough, right, for the risk that you're taking on, given those changes. And I think that's the part, is just stretching on those things. You gotta back off that. And that's why it is. I mean, it's important that you look at, you go in with sort of high level stuff, but go into every deal, and you have to take it on its own. Like this, it's its own thing, right? And you can't shortcut it. You can't just broad brush stroke it. And once again, it just goes back to, I think that's where the value is of having, the Seth Bradleys of the world and other guys like you that sort of play that role. And because it's what keeps the whole thing in check, right? And whereas it sometimes for the operators or some of those guys that there's no one sort of there's no accountability there of going like, no way, man. And that's just no way that's going to happen. And kind of that give and take to like, dude, you need to sharpen your pencil, because there's just no way in hell that's ever going to happen.
Yeah. And you probably see it all the time too, man, because we're parts of like different groups. I mean, in groups and, social groups and things like that. I mean, there's just so many people in the space now. And man, some of these guys turn these OMs, and I'm like, they're like, hey, what do you think about this deal? And I'm like, oh my God, like, I just feel bad for some of the people that decide to trigger on with them.
Yeah, no, I know. And seeing that's what scares me too. And that's why I asked this question. I'm not trying to like, it's just, that's the thing. It's just, okay, it gets crazy, and that's the stuff that scares me. And I certainly the same. It's like, I feel like, take action. Like what can we do to sort of stop that from happening? Cause that would be bad for the industry in whole. If I get it, man. Like, everyone looked like geniuses. Okay, great. But we're in a different world now. And I don't want to be the guys like Chicken Little, the sky's falling, but it's like, it's different. And so, you have to proceed with caution. If you were able to escape, I mean, not to mention all the deals that got done before, pre-COVID there or whatever in the last 18 months or whatever. I mean, if you're still thinking that you're going to get whatever that pro forma said, I mean, I think you need to check yourself, because it's not going to happen. Yeah. And, and I don't care how good you are. I mean, like, and once again, if you squeeze it out, great. But I mean, the expectations need to be reset on those deals. And now all deals going forward, you just have to change the way that you look at things. And, and especially with the beauty of real estate, right, is that it's not as volatile, the stock market, right? Like, you don't have these wild swings, but it's just every market's different. And it's down to the sub market, right? From this sub market here, and this one is different. And I mean, that's the thing. And so there's a ton of benefits that can accrue from investing in this stuff, but it's not just, it's in many ways it is simple. for those who are, if you know what you're doing, it can be simple, especially like multifamily is like pretty straightforward. And, compared to like a mobile home parks or like the dynamics can be really crazy there. I know people want to think it's really simple too, but self-storage, pretty damn simple. There's a lot of supply and demand, there's a lot of things that you can get your mind wrapped around, and multifamily is kind of in that thing too, but you can get your ass handed to you you got to know what you're doing, not to scare people off, but it's just like there's a method to the madness, and it requires experience and skill, and it's all the stuff be acquired, but you can't just show up and suddenly, become the, God's gift to multifamily, in 6 months or something.
Yeah, agreed. I mean, I think that's what a lot of people do is like, and there's a lot of intelligent people that come into the space. I mean, they might be really good at what they do during their day job. They're good at corporate finance. Maybe they're good at being a doctor, whatever it might be. And they think that real estate is easy, but it's not. I mean, it's just like anything else. It takes experience, it takes time, it takes knowledge. And, that's just the part of the value that we're creating.
Yeah, no, it's great. So why don't you tell us how we can find you? Because I think that a lot of what we've been talking about, it is kind of what your aim is, sort of with the podcast in particular, I think, right?
Yeah, for sure. If you go to passiveincomeattorney.com, that's the podcast website. That's the best way. We've got some freebies as well. If you go to attorneybydesign.com, we've got a nice free on there for you to download, and we can get connected in that way. I'm on all social media platforms. Just look me up, Seth Bradley.
Cool. All right, Seth, it's been great, man. Thanks so much for your time. I appreciate it.
Thanks, Lance.
All right, take care.